Good morning to everyone. My name is Tan Jun Chua and my metric number is 306335. Now I will start to present a study on credit risk determined of Arab National Bank in Saudi Arabia between 2015 to 2024. This slide will show the introduction of this assignment. First, the Saudi Arabia has one of the strongest banking sector in the Middle East. The Arab National Bank (ANB) is one of the leading commercial banks in Saudi Arabia. The credit risk remains one of the major challenges faced by commercial banks, and the economic events such as oil price fluctuation, COVID-19, and recent 2030 reform may influence bank credit risk. The problem statement of this assessment is credit risk will affect profitability and financial stability, and limited study focus specifically on AMB. Thus, is understanding the determinant of credit risk help improve risk management. The research objective of this assignment is identify internal factors affecting credit risk, identify external factors affecting credit risk, and examine the combined effect of both factors about the credit risk. The research question is: do internal factors affect credit risk? Do external factors affect credit risk? Do both factors driving affect credit risk? The credit risk is a risk that borrowers fail to repay loans. The internal factor that I use in this assignment is ROA, liquidity, loan loss prevention (LLP), CAR, RWA, and the leverage. The external factor is GDP, inflation, interest rate, exchange rate, reverse money M2, and the yield curve. Now I will explain the methodology of the assignment. The research design of the assignment is secondary data annual report of AMB and the Saudi Central Database. The study period is between 2015 to 2024, which is 10 years. The independent variable is internal factor, external factor, and the internal and external factor. The dependent variable is credit risk. There are three regression models, which is Model 1, Model 2, and Model 3. Now I will explain the descriptive statistics of AMB. The key findings show that the mean credit risk of AMB is 4.48%, the average of ROA is 1.62%, average loan ratio is 68.45%, the CAR is 18.16%. These results show that AMB maintains relative low credit risk and its profitability remains stable. The capital position remains strong. This slide shows the trend analysis of the assignment. The finding result credit risk declined until 2017 and increased after COVID-19. The GDP fluctuated significantly. Inflation remains relatively stable. For the financial performance, the liquidity decreased after 2018. The CAR remained above regulatory requirements. The bank side increased continuously. The reverse money (MN2) generally increased. This slide presents the present correlation and p-value analysis. The purpose of this test is to determine the strength of the relationship between each independent variable and credit risk, as well as whether the relationship statistically significantly. Based on the present correlation result, none of the variables show a strong relationship with credit risk. However, three variables demonstrate moderate negative correlation. This negative correlation indicates that higher loan loss prevention, stronger liquidity, and high reverse money are associated with lower credit risk. This suggests that maintaining efficient polarization and liquidity may help reduce potential credit loss. The p-value analysis shows that the long loss polarization is the only variable that is statistically significant, with a p-value of 0.039, which is below than the 0.05 significant level. Equity and reserve money record p-value of 0.065 and 0.057 respectively. Although they are not statistically significant at the 5% level, they are considered marginally significant because this study used a 10% significance level due to the limited sample size. Although the findings indicate that loan loss poison is the most important determinant of credit risk in Arab National Bank during the period from 2015 to 2004, while liquidity and reserve money also appear to have some influence. This slide presents the regression analysis, including the model summary and ANOVA result. The purpose of the regression analysis is to determine whether the selected independent variable can explain changes in credit risk. Three regression models were developed in this study. Model 1 includes only internal factors, Model 2 includes only external factors, and Model 3 combines both internal and external factors. As shown in the table, all three models record negative adjusted R-squared value. This indicates that the selected variables do not explain the variation in credit risk better than a simple average model. The ANOVA results further support this finding. The significant value for all three models are greater than 0.05 and also greater than the 0.1 significant level used in this study. One possible reason is the small sample size. This study only includes 10 annual observations from one bank, while more than 20 independent variables were initially considered. This reduced the statistical power and made the regression estimates less stable. Although the regression models are not statistically significant, the analysis still provides useful evidence that loan loss poison, liquidity, and reserve money appear to be the most relevant variables affecting credit risk. As a conclusion of this assessment, the LLP is the only one statistically significant determinant. The liquidity and reserve money are marginally significant. Most variables of this assessment show weak or moderate relationship. The regression models are not statistically significant. The limitation of this assessment is the small sample size and the single bank only. And the limited variable also was a limitation of this assessment.